A lot to digest this morning, from the trade headlines between the United States and Japan to all of the earnings stories we are sorting through, and a stock market that's been near all-time highs. Jimmy Lee joining us now, CEO of the Wealth Consulting Group, one of our regular guests. Jimmy, nice to see you. Lots of moving parts in these might sometimes be seen as a slow summer stretch. What's catching your eye right now?
Oh, great to be with you. And I just got back actually from your beautiful country a few weeks ago up in the Muskoka Lakes area with my great friend up there. And I had a chance to talk to a lot of my Canadian friends who are business owners. And, right now, obviously, we're talking about tariffs and trade talks. And I think everybody, both Canadians and Americans, want to get a deal done. And so I think that's important. The other big news is that earnings and sales and margins actually here in the United States has been pretty strong. We've had an incredible first half of the year. I don't think anybody thought in the lows of April that we would be where we're at in the markets right now, including overseas markets outside the U.S. We actually believe there's a chance for the S&P 500 to hit 7,000. And we actually said that when the market was still going into bear market territory almost intraday in April. And we continue to like those cyclical sectors because we don't think that the United States is going to fall into recession. And we do believe that the Fed lowering rates would be helpful and view that as a potential risk out there. But there's a lot of action. It's not been a boring summer so far.
Okay, a lot to chew on there. I want to go through a few things you talked about. First of all, just on the math on 7,000 for the S&P 500, that would suggest at least 10% more upside. What's your kind of your thinking on the roadmap towards a milestone like that, like the amount of time it could take if the momentum we've seen continues?
Well, you're just talking about it. The plain energy has all been driven by this investment in AI that at the beginning of the year, I think a lot of people were questioning how that was going to turn out, especially with the news from DeepSeek out of China. And really at this moment, it looks as if the hyperscalers are going to continue to invest a lot of capital. And we're not over yet. My good friend Dan Ives likes to say that we're at 10 or 10:30 p.m. at a party that goes till 4 a.m. So he thinks that we're still early. I think that the cycle will continue to be invested in terms of AI. We're starting to see that those second derivatives of those plays into AI, show up in terms of share price, whether it's energy plays or a company in that space. So AI has been a big theme that's been, a big positive behind this. But in the United States, even though we haven't had aggressive Fed cuts yet, we're looking forward to lower interest rates. That's going to be a huge tailwind for business activity to pick up, whether it's private equity deals picking up, maybe more public offerings and those being successful. We're also looking forward to deregulation. And so I think there's a lot of optimism there. Also, we had the Genius Act passed recently, and a lot of people that are in that space were desperately seeking for, a resolution and having some regulation in that area, and we've got that now. So I think there's a lot of positives and optimism. Of course, the tariffs are still in the headlines, and with the recent announcement of Japan, I think that's helping to move the markets up. And I think a lot of investors have gone beyond the social media posts from the White House and deadlines as they keep moving.
Okay, and then just to pick up on what you were saying about interest rates in the U.S., what do you think the runway looks like there? It sounds like you think that there is a runway for rate cuts, but I know that's been heavily debated on the street.
Yes, we do at our firm. We think that we should, get possibly 2 cuts. There are a lot of people saying that there was going to be 0 cuts. So we need to start cutting at some point here. And I think that there's been a lot of pressure put, on the Fed chair from the White House and other folks. And hopefully there's not a change and he gets to write it out, because I think it'd be very disruptive for the markets. But that being said, I think that we do need lower rates and move certain areas and certain sectors of the economy better, such as housing and other areas. And so I think maybe we'll get 2 cuts this year, and I'd be happy about that.
And before I let you go, the other thing that I was wondering as you were talking, Jimmy, is that even though the market is at an all-time high, now that we're into earnings season and we've had a few examples where the tariff tensions seem to be, in a very real way, impacting either outlooks or bottom line performance. Like yesterday, everybody was watching GM sell off. We were talking about Texas Instruments today. In Canada, we've been talking about CN Rail. So not all companies have been created equal in this all-time high rally. And I just wonder, what would be your advice to investors in trying to navigate that?
Very true. I think this year is important for active investors, and so even in the tech sector, for example, that's done very well. There are a few companies there, really because of geopolitical risks, that have not participated in this comeback. And so I think you need to look at your portfolio, look underneath the hood. Many investors are passively investing; they've been doing that for a long time. There's nothing wrong with that, but you end up with not such a diversified portfolio. And if you are actively investing, I think it's important to do your research and see which companies are navigating this tariff environment better than others. And so I'm a big proponent of active and passive investing, but right now I think active is very important.